So here we have our second part of the financial statements, balance sheet. Balance sheet which tells you how much I own and how much I owe in my business. Balance sheet in simple terms can be understood by this equation. Assets is equal to equity plus liabilities. Repeat with me again. Assets is equal to equity plus liabilities. Now we are not here to understand how balance sheet is prepared because that is the job of accountants. We are here to analyze our balance sheets. But understand this thing, every balance sheet in the entire world of any company follows this principle. That is assets is equal to equity plus liabilities. Now what does this statement means? This statement simply means that my assets are funded by two things. One is the money which I put as an owner, that is my equity, and other is the money which I borrow from others, that is debt or liabilities. Balance sheet is nothing but a representation of how much money I have put in my business, that is through equity and through debt, and what I have used that money for, that is my assets. Balance sheet by nature always balance. What I mean by that? Liability side will always be equal to asset side. Now a typical balance sheet usually look like this. Here we have two sides to the balance sheet and these two sides will always equal together. On the liability side, like I said, we have only two sources. One is equity and the other one is debt. So debt plus equity or liabilities plus equity is equal to assets. What are the liabilities? The liabilities, very simple, can be of just two types. One liability is long term. What I mean by long term liabilities? Those are those liabilities which are to be repaid after a year. Why we have taken liabilities after a year? Because this is a standard operating procedure in the entire world. For a very, very long time, a liability which is not to be paid during this year is considered a liability which is of long-term nature. So the long-term liabilities are written separately in the balance sheets. The next comes current liabilities. Current liabilities are those liabilities which are to be paid within that year. So that means if a liability is to be paid within 365 days, then that liability is called current liabilities. Now there are certain other liabilities which are basically considered in the head of other debt. Other debts are nothing but just another way of saying other long-term debts. So long-term and other debt can be classified as long-term debts and the current liabilities are basically short-term debts. So this is how the debt side of the liability side is shown. The remainder of the liability side is represented by owner's equity. What is owner's equity? In very simple terms, it is your skin in the game as an owner. What has owner put as his own money in this business? And this is one of the key component when bankers or investors are looking to invest in your company. How much of your own money have put in your own business? Now, this is the liabilities part. Now, these liabilities are used for what? They are used to purchase assets. What are assets? So like I said, in short-term and long-term debt, assets are also divided by long-lived assets and short-lived assets. So what are long-lived and short-lived assets? Like I said, the 1 year's time frame, this is also considered in the 1 year time frame. So if any current assets, that means those assets which are only available, which are expected to be realized or converted into cash are considered short-lived assets. These current assets or short-lived assets examples are inventories. We usually expect that the inventories will be sold within that year. Stock, inventories, account receivables, these are all examples of current assets. Even cash or bank balance is a current asset. And what are fixed assets? Fixed assets are basically those assets which are there for the long term. They are not there to be sold within a year. They are usually assets like property, plant and equipment. Basically those assets on which you generate your revenue. For a manufacturer, it can be its factory, its plant, its machinery, its equipments. For a service provider, it can be its office building. So these are considered fixed assets, which are not there to be sold, which are not there for the trading, they are there for the long term. In the later videos, you will see that we will take balance sheets of real world companies. And in almost all the balance sheet, you will see a figure called marketable securities and non-marketable securities. These securities are actually example of financial assets. Financial assets means, in simple terms, shares, stocks, mutual funds, government security yields, and even sometimes cryptocurrencies these days, which have been invested by the company to generate what? To generate interest income, dividend income, or even capital gains income. The last part of example of assets are intangible assets. Intangible assets means basically your goodwill. Now, goodwill are considered by many to be asset. In reality, goodwill is not an asset. You know what is goodwill? Goodwill is a declaration that yes, I have purchased something which is much more expensive than what it was worth. So what usually happens is, let's assume that Google acquired a company, Alphabet acquired a company, and when that acquired that company, the value of that company was, let's say, $1 billion, but Google, let's say, paid $1.5 billion for that. So the difference between 1.5 and $1 billion, that is $500 million, will be shown as goodwill. Why you have paid $500 million more for that company? Because you believe that this company will grow more in the future. And even though its balance sheet shows its current worth as $1 billion, but we are paying $1.5 billion because we assume that this balance sheet actually has something intangible, something hidden, which can be utilized by Google in the future. So this is called goodwill. And this usually crops up when you have made acquisitions and those acquisitions are higher than the book value.